This is Dan Stewart for your daily market update. Tuesday, June 22nd, 2010. Well, the market was slightly positive at the beginning of the day, but then it gradually sold off over the course of the day. The Dow ended up down 148 points, the S&P down 17, and the NASDAQ down 27. Gold was flat, and so was silver. Over in Treasuries, yields were down slightly, therefore prices were up. On the currency front, the US dollar was stronger against the euro, but weaker against the Japanese yen and the British pound. Asia was down across the board, as was Europe. But the big story of the day, House Majority Leader Steny Hoyer announced that the US government would not submit a formal budget this year. Excuse me? What? No budget? I'm not sure, but I don't think that's ever been done since the inception of our country. You've got to have a budget. Otherwise, how do you know where you stand? You may overspend just like we do almost every year, but at least you got a guideline. Their excuse? Serious structural problems that preclude them from having a reasonable budget and not having the deficits balloon. Their solution? To pass a budget enforcement resolution to curtail spending. And Representative Hoyer said, and I quote, "It is impossible to debate and pass a realistic long-term budget until we've considered the Bipartisan Commission Deficit Reduction Plan. That's expected to come out in December, conveniently after the November midterm elections." What they really don't want you to know is how their projected numbers and deficit is ballooning way beyond what they projected. Their expenses, their cost, are up much higher than they projected, and their revenues, based on the GDP growth that they projected, is much lower. They projected a GDP growth of over 3%, and it's slowing, and it's much lower than that. And so now their tax receipts and tax revenues is not nearly what they thought it would be. And their expenses are even higher. Therefore, that $1.3 trillion expected deficit this year is going to be much, much higher. What does that mean for you as an investor? Well, in the mid to long term, it means that the US dollar is going to come under great pressure. Their only real solution is to devalue the dollar significantly and pay off on devalued dollars, or have drastic cuts. They haven't shown the wherewithal to create any pain yet, so I don't see them taking that route. I believe they will cause inflation via devaluation of the dollar. That means you won't want cash. U.S. cash and U.S. Treasuries will be dangerous. You're going to have non-U.S. denominated bonds and currency. Certain sectors, such as commodities and raw materials, and other non-U.S. assets. It's going to be a completely different world than you've been used to. You're going to have to start thinking differently, and you're going to have to start being proactive rather than reactive. Once it becomes apparent to the masses, it's going to be too late. This is Dan Stewart for your daily market update.